Welcome back to the EIS Navigator, the podcast for UK venture capital. I'm your host, Brian Moretta. Today, we are continuing with our EIS Basics series, and we are talking about SEIS, or the Seed Enterprise Investment Scheme, as it's known. Today, I'm joined by Jeffrey Faustin, who is a managing partner at Jenson Ventures. As a reminder, as well as the audio version, we've got a YouTube channel for this, so you can see the video version, or if you're watching a video, you can get an audio version as well. So, welcome, Jeffrey.
Hi, Brian. Thanks for having me.
Our pleasure. As usual, we like to let you establish your expertise a little bit. Can you maybe tell us who Jenson are?
Yeah, sure. No problem at all. So Jenson Ventures is a fund manager that's been operating in the SES and EIS space since back in 2012. We've backed over 150 companies through both schemes, the SES and the EIS. And we're focused on supporting founders from day one. I guess the thing that makes it slightly different is the structure and the support that we provide, helping founders to grow and just manage risks in general.
So today, you mentioned you're investors in Seed Enterprise Investment Scheme. We're just going to call it SEIS. Yeah. Maybe tell us what the aim of SEIS is.
Yes, sure. So SEIS has been set up as a scheme that was launched by the UK government back in 2012. The aim of it is to encourage the earliest end of the risky stage startups and encourage funding into those startups. Because it's high risk, you find that it's very difficult to get the right level of funding in it. So the government, on the success of the EIS scheme, decided to go one step further and launch the SEIS scheme. It is set up to give very generous tax reliefs to investors who want to take that risk at the early stage. And, Jenson is one of the first funds to do that. We actually have the longest running SES fund in the market. So we are very much involved in trying to help work across those types of businesses. But yes, the scheme was there to really help get early stage companies access to funding using a tax as an incentive for investors taking that risk.
So how does the government ensure that companies are getting new money?
Yes, good question. So to ensure the companies are getting new money, there are specific rules around the scheme in terms of how companies can raise capital under the scheme. They have to issue new shares that don't allow for any predefined returns to the investors. The business has to be of a certain size, so they have to have less than 25 companies. They have to have gross assets of less than
25 employees.
25, did I say companies? Sorry, 25 employees, correct? Less than 350,000 pounds of gross assets. They have to be trading for less than 3 years. The shares that are issued have to be issued as part of paid up cash. So it has to be for cash. It can't be for kind. And there's certain criteria on which who can invest in the company. So directors can't actually purchase those shares. So there are rules to ensure that the right investors are taking the right levels of risk into the right companies to ensure that the innovation that these companies are trying to develop actually gets funded in the right way.
Yeah. And I think probably the one thing I might add to that is that the shares shares are unquoted as well.
So yes, of course, yes.
Yeah, I think theoretically aim is possible, but I think the practicalities that make it almost impossible to happen.
Yes, you're probably right. I guess for doing it for this long, for over 12 years, you take that as a given, but actually that's a very good point.
Yeah. So maybe you talked about sort of the rules. In practice, what sort of companies does that actually mean that people are investing into?
These are early stage companies that are either pre-revenue or just recent revenue. And again, with that 3-year trading rule, is not, and that £350,000 gross asset limit. Companies of a certain size, it can be a range of trades. There is a list of specific trades that are allowed. It's quite a long list. So, it's probably shorter list of what's not allowed, if I'm being honest. But it'll be companies from quite a wide range. We are an agnostic fund. So we actually invest we do AI tech to actually consumer products, and everything in between. So it is quite a wide range of companies that can be invested into. And it's just designed to be very early stage businesses. It's companies that may have developed their products, or maybe looking to develop their products at that stage, may have already defined their markets and defined their route to markets, or may not. But it can be it is meant to be for very early stage companies.
Yeah. And you mentioned sort of AI stuff. Is it all technology, or do you see other things as well?
No, this is not all technology. I think as a fund manager, there tends to be a focus on more capital efficient, more high growth businesses. But this actually is a tool, is a mechanism to get funding into, quite a variety of startups. There can be product based companies as well. It can be more retail oriented companies as well to a certain extent. So yes, the intention here is to actually really aid most types of early stage companies. As a fund manager, we probably focus on the high growth aspect of that.
Yeah. And so I think other fund managers, there's some fund managers who are like yourself, generalists, and some that have specialities in different areas.
Yes.
And I suppose, the next practical thing is, if an investor wants to invest in these things, what's their options in terms of sort of finding companies?
There are lots of different routes to actually invest into companies that meet this criteria. I guess the first one is direct investing through your own personal network. There's an opportunity to do that. We've seen occasions where, investors know the founders and have decided to, almost have friends and family around, taken the tax relief from that. Another common route would be for investors to go through angel groups and angel networks, where those groups and clubs present opportunities to investors, and they decide which ones meet their specific criteria. There are crowdfunding platforms as well that offer the opportunities for investors to invest once they subscribe to that platform, become a member of that platform. And of course, there are funds like us and many other, funds that offer specific SEIS and EIS products. We are, like you said before, we're a generalist fund, so we will invest across, a complete range of types of opportunities. And then you have more specific sector focused managers as well. If you are inclined to a specific sector, you can find funds that probably suit that.
Yeah. And obviously your experiences as a fund manager. So how do funds actually invest in practice?
We have a requirement to have a diversified portfolio to offer to our investors. So what we actually do in practice is we raise funds quarterly and hold those funds, and then use that to deploy into companies. We see companies, we see well over 3,000 X a year. And we try to have a regular and repeatable method in which we screen, review, assess, and negotiate and select companies to invest into on behalf of our investors. So we will often raise a fund, close it, and then tax year is kind of how we do it.
That is probably the most common model in the SEIS market, where people, whether they call them funds or tranches.
We call it tranches again, most funds will aim to deploy within a specific tax year, the tax year that the investor puts their money in.
Yeah. Most, but not all. I think we should highlight that.
Absolutely, and there's arguments for doing both, really.
Yeah. So once you're actually in this company or in these investments, you're hoping for return. How should people expect to get something back from them?
Well, I guess the first thing we should kind of highlight is the fact that there is a minimum holding time of 3 years for the SS investments. And that can be a bit tricky to explain to investors, because there may be an anticipation that, on the third anniversary, there's a return opportunity. In actuality, because these investments are very early stage and high risk companies, they do take some time to mature and get to a point. Most investors can expect a return via an exit of the entire business, specifically the SEIS. It's very, very rare that a company will progress all the way to a listing. In most occasions, you would expect an exit, which will occur through the sale of that company at some point in time when it's sufficiently mature to attract an acquirer. There's also additional routes to exit whereby the SES shares are bought out at a later stage round. That's also a scenario that we experience as well. So those are the two main scenarios. The key thing here is the time frame. I would expect that investors should be looking at a minimum of 5 to 7 years of a holding time into specifically for SES companies because of how long it will take to scale to a level of maturity where it can be acquired. So those are the two things. The other thing I would probably note for investors in terms of managing expectations is that, particularly with a portfolio approach to SES investing, there is an expectation that not all of the companies will succeed. And those that actually don't succeed that will occur in a much shorter time frame than the actual exits. So you will have that as well to, as part of the process. One of the things that this scheme allows for is loss relief. So there is an opportunity for investors to get a partial return on companies that have not been successful. So there is that option as well.
Yeah, and we'll go into that in more detail in the next episode. I'll agree with you on timing. I think 5 to 7 might be an average. I think people should be prepared for some of their investments, and if you're unlucky, maybe quite a few, to take significantly longer than that.
Absolutely. And I think the expectation originally was that it would be an average of 5 to 7. I think it's a minimum of 5 to 7 now. And you're probably looking at 7 to 10 years in terms of an SES investment because of the additional stages of growth that it has to go through.
Yeah. No, I think that's very reasonable expectation to set for people. So if people want to find out more about what you're doing at Jenson, where should they go?
They can look us up online. It's in terms of Jenson, with jensonventures.com. They can reach out to us via the EISA website, or they can speak to the lovely folks at Cotton.
Yes, and we will happily put you in touch. So thank you very much for coming on today, Jeffrey. Really appreciate you coming on and explaining things about all things SEIS.
Thanks for having me, Brian.
Our pleasure. As usual, listeners or viewers can get full show notes with links at harmonandco.com/podcast. You can subscribe to the podcast on all good podcast services and players, or through the link in show notes, or just hit subscribe on YouTube. If you liked what you hear, then please tell a friend or a colleague, or give us a review on your favorite app. We can be contacted at inquiries@harmonandco.com. Thanks for listening and viewing, and we'll be back next week with another episode.